Welcome back, everyone. Let's jump right into today's explainer. And honestly, this one is absolutely fascinating. We're tearing down Teradyne's explosive Q1 2026 earnings report. Look, if you've been tracking the markets, you already know the AI hardware space is running white hot right now. But while everyone's fixated on the big-name chip designers, there's this massive underlying foundation making the whole thing tick. Teradyne just dropped a quarter that completely shattered expectations. It reset their financial baseline and literally sent Wall Street into a frenzy. So we're going to break down exactly how they pulled this off, who they're up against, and figure out if their current stock price actually makes any sense.
So it's the multi-billion-dollar question, right? Who actually tests the chips that power this entire AI revolution? I want you to look at Teradyne not as an AI creator, but as the ultimate pick-and-shovel infrastructure play. Before any of those advanced AI accelerators, memory modules, or custom ASICs actually hit a massive data center, they have to be rigorously tested. They've got to work flawlessly. Think of Teradyne as the ultimate unglamorous bouncer at the hottest AI club on Earth. If a chip doesn't pass their test, it is not getting in. And as these AI architectures get vastly more complex, testing gets exponentially harder and way more lucrative. They provide the automated testing equipment that makes this whole boom physically possible. They're basically the gatekeepers of quality for the entire semiconductor industry.
Okay, let's dive into this because these top-line numbers are just staggering. For the first quarter of 2026, Teradyne posted a massive 87% year-over-year revenue growth. 87%! They raked in $1.282 billion in a single quarter, absolutely crushing the high end of their own guidance. I mean, when you're a legacy tech company dealing in heavy physical testing equipment, almost doubling your revenue in 12 months, that's not just a solid quarter, that is a total paradigm shift.
And honestly, looking at exactly where that cash is coming from is even wilder. Their semiconductor test segment, you'll usually hear it called semi-test, broke the $1 billion threshold for the very first time. It brought in $1.111 billion all on its own. That is over a 100% year-over-year jump for just this one specific division. This proves that the absolute explosion in semiconductor manufacturing isn't just some theory analysts are debating. It's happening right now on the factory floor, and it's dictating the pace of the tech we use every single day.
But, top-line revenue is only half the story. The real question is always how this translates to the bottom line. Well, non-GAAP earnings per share surged from 75 cents in Q1 of 2025 to a massive $2.56 in Q1 of 2026. Guys, that's a 241% jump in earnings per share. It tells us Teradyne isn't just pushing out more units, they're selling highly profitable, highly advanced units. That violent translation from top-line revenue straight to bottom-line profit, that's exactly what institutional investors are hunting for in a growth cycle.
So let's dig into the why beneath these massive numbers. This surge is almost entirely driven by the accelerating demand for AI and data center tech. In fact, AI-related demand has surged to account for nearly 70% of Teradyne's total revenue. And what makes this so wild is just the velocity of it all. Just one quarter ago, AI made up about 60% of their revenue. The entire DNA of the company is being rapidly reshaped by the gravitational pull of artificial intelligence.
Which brings us to this quote from leadership. They noted that compute driven by AI now represents roughly 75% of SoC product revenue, highlighting a strategic shift from mobile-centric to AI-dominant testing. This is brilliant because it perfectly illustrates Teradyne's deliberate pivot. For years, mobile and smartphone chips were the massive volume drivers for semiconductor testing. But Teradyne successfully steered away from relying too much on mobile. They pivoted their system-on-chip, or SoC testing, directly into the booming AI compute space. They've essentially caught the perfect wave at the absolute perfect time.
Now, of course, when there's this much money on the table, you're never alone. To keep things objective, we have to note that Teradyne faces incredibly stiff competition. Companies like Advantest and Kuhu are aggressively rolling out new solutions purpose-built for AI chiplets and high-performance computing. For example, Advantest just launched a new pin-scale solution that boosts vector memory testing up to 5 gigabits per second. Meanwhile, Kuhu is locking down major orders for platforms with advanced thermal control. So the arms race to test the best chips? It's honestly just as fierce as the race to build them in the first place.
Section 1. Teradyne versus Cisco. The AI infrastructure battle.
To really understand the broader landscape, we need to compare them with another absolute giant in the space, Cisco Systems. Both are totally critical to the AI rollout, but their roles are very different. Teradyne operates at the very origin point. They provide the automated testing that ensures the raw chips and high-bandwidth memory actually work right out of the foundry. Cisco Systems, on the other hand, comes in later. They're providing the enterprise networking, the Silicon One systems, and the optics that actually connect all those functioning chips together to build these massive working AI data centers.
And we absolutely have to give Cisco credit for their massive scale here. In just a single quarter, their fiscal third quarter, Cisco secured $1.9 billion in AI infrastructure orders specifically from hyperscalers, the massive cloud providers that essentially dictate the market. Their year-to-date AI orders have already hit $5.3 billion. They're seeing triple-digit order growth as organizations completely overhaul their networks to handle these insanely heavy AI workloads.
But when you line up their growth headwinds side by side, it's pretty clear why analysts might favor Teradyne right now. Teradyne is currently operating almost like a pure-play AI and compute growth engine. Cisco, despite those incredible AI numbers we just talked about, they're being dragged down by their legacy businesses. They're battling declining services revenue, flat security product sales, and a near-term revenue drag from shifting their Splunk business from on-premise to cloud subscriptions. Teradyne just doesn't have that kind of legacy anchor weighing down its top-line growth at the moment.
Section 2. Wall Street's verdict. Price perfection? So, we've seen the jaw-dropping growth numbers, and we understand the competitive landscape. But how is the market actually pricing all of this? Let's start with the optimism. The street is incredibly bullish on Teradyne's near-term future. Right after this earnings report dropped, we saw a massive flurry of analyst upgrades. Zacks Investment Research gave it a #1 rank, a strong buy. JP Morgan bumped their price target up to $400, and UBS came in swinging with the highest target on the board at $440. Wall Street sees that 87% revenue growth, and they're betting the AI spending cycle is just going to carry Teradyne higher and higher.
Okay, but we need to execute a bit of a bear pivot right here, because there's a flip side to all that optimism. Thanks to this massive run-up, the stock is up over 85% year-to-date, Teradyne is now trading at a really steep forward price-to-sales ratio of 11.6x. To put that into perspective for you, the industry average for electronics and miscellaneous products sits around 9.69x, so you are paying a very hefty premium for every single dollar of sales Teradyne brings in.
So the absolutely crucial point here is understanding the risk of paying that premium. Zacks currently slaps Teradyne with a value score of F. An F score basically means a stock is trading at a significant premium and might be overvalued relative to its traditional underlying fundamentals. What this means in plain English, a flawless future is already priced into the stock. Any misstep, any random supply chain hiccup, or even just a slight slowdown in AI capital expenditure could trigger a really sharp correction, because this valuation leaves literally zero room for error. Now, looking ahead to next quarter, Teradyne's own guidance shows they are highly confident they aren't going to stumble. For Q2 2026, they're projecting sustained momentum, expecting revenue to land somewhere between $1.15 and $1.25 billion. They fully expect to easily maintain this brand new billion-dollar revenue baseline, mostly driven by continuing demand for high-bandwidth memory, or HBM, and flash testing. Basically, they're telling the market, hey, Q1 wasn't a fluke, this is our new normal.
Which leaves us with this final, critical question to chew on. Is the AI testing boom truly just getting started? Meaning, is this 87% growth just chapter 1 of a massive, multi-year supercycle? Or does Teradyne's premium price tag already have a flawless future perfectly baked in, meaning the easy money has already been made? It is such a fascinating standoff between undeniable, explosive fundamental growth and a valuation that absolutely demands sheer perfection. Thanks so much for joining me for this explainer. Keep asking the right questions, and I'll catch you the next time.